Welcome to Cheques and Balances. I'm Michael Vincent, this is James Blair, and today we've got a special guest, Matthew Harris, one of the directors of Lighthouse Financials. Cool, so today we had a topic already lined up. We had a show pre-recorded, and it was actually a question that one of the listeners had sent in, so big thanks for that. But due to some recent developments in the market, shall we say, we've decided to sort of cut that and release something a little bit more topical. So we'll get back to the regular program next week, so bear with us. So today we had, maybe you could call it a legislation change, a tax policy change. Some might call it a bit of bad news. For the investment market and property investors especially. So we've got a special guest on who's just going to help us sort of run through what that means so far, what we can decipher from the signalling that the government's given, and how we can potentially respond to that.
And we might call it, while it's a legislation change, it's a bit of a 1-2 to any property investor. And I know we've got this sign behind us in every episode. Matt, I think it might be a little bit dimmer today than usual.
I actually should have turned it down. This webinar actually. Look, you can call it a legislative change, you can call it a rule change, you can call it a punch in the face for property investors. Basically feels like the same thing.
Yeah.
And that, for the context for the listeners, we have come off more than a 12-month period of pretty significant changes for property investors. We've had ring fencing of rental property losses, we've had Healthy Homes Act, we've had letting fees removed, tenancy rule changes twice.
Yeah.
So all of these things make a property investor's journey quite a bit more difficult. And when we look at property investment now, it is a business and it should be treated as such. So this is effectively making it hard for business people.
Yeah, absolutely. So, Matt, I mean, our phones have been going hot all day going, what does this mean? Everybody's got an opinion that they're chucking up a blog or a news article. For those that are trying to process what it means, can you give us a quick snapshot of what were the changes that were, which we should point out are proposed? What are those changes?
Yep, so there was two main changes today. One is not proposed actually, already enacted from 27 March. That is the 5-year to 10-year bright line rule. So effectively, the bright line rules came in first in 2015. In a nutshell, what they say is if you buy and sell property within a specific time period, you pay tax on the gain.
Yep.
It was restricted effectively to 2 years originally, then it was 5 years, and now it's 10 years. So it looks more now like a quasi capital gains tax than it did originally, which was a stop people buying and selling in a short time period.
Yeah.
So the major talking point in that today is that it still will be 5 years for new builds.
Okay.
And I think that really indicates that the government has got one tiny bit of the equation right, which is that the supply of new builds basically equals the problem in New Zealand housing market.
Yeah, no, exactly. And I guess, for some of our customers who are potentially a little bit shaken, understandably a little bit nervous about their portfolios and what it sort of means for them. Is there any hope? Is there any good
Should
news?
We sell
in the
everything?
News? Yeah.
Yeah, no, I don't
Do
think
we
it's time
liquidate
to
the
sell
whole
everything
thing?
and get a boat? Look, I think the bright line part of it is something that a lot of investors will be able to live with, especially in this business. You guys are aware, we predominantly deal with long-term buy and hold investors. They are building wealth over a long period of time. Traditional wealth creation cycle is about 8 to 10 years anyway.
Yeah.
Bright line's not an issue. The bigger change, and the second part of this conversation, is that the government is proposing to remove interest deductibility for property investors. So that is pretty big. It goes against general tax law, which says that if you incur an expense in deriving assessable income, you should be able to deduct that costs. And more than that, they are segregating a specific part of the business community.
Yeah.
And I use the word business a lot. I truly think property investment is a business, and the people who treat it like one do better. And you're dealing with big money, big risk nowadays.
So, Matt, for those that maybe don't have a investment property yet and have been thinking about it, or they just trust their accountant, Mr. Taxman will look after it for me. Interest deductibility, what does that mean, and why is it a big issue?
Yeah, so when you buy a property, the main cost of owning that property is interest. Luckily, over the last year, interest rates have dropped significantly. Nevertheless, if you have a $700,000 mortgage, you're probably looking at about 20 grand a year
Yep.
of interest deductions, more or less. The tax outcome on that 20 grand is probably about $9,000.
Yeah.
So what it means is that people who derive rental income and have an interest deduction as their main expense, they will end up in a highly profitable position from a tax perspective.
Yeah.
But their effective cash flow will be well down, because if they're reducing principal, they're going to have to take that off, reverse the interest deduction, pay the 10 grand or whatever it ends up of tax,
Yeah.
and then figure out where the rest of the money is going to come from. So it's well out of line with general accounting concepts.
Yep.
Your book profit is not going to match your cash flow by a long way.
Yeah.
Which kind of becomes quite deceiving when, if you treat it like any other business, which we encourage our clients to do, is to treat property like a business. Say if you ran the local dairy, for an example, that you got your revenue less your expenses and you end up with a profit.
Yep.
But in the dairy example, then you've got another significant expense after your profit and after what you could claim back on your tax that you then have to sort out off the back of it.
Yeah, that's right. Imagine you're running that dairy and you have your net profit, and then the inlay revenue says you have to add back half the lollies you bought as stock. That's kind of what it looks like.
Yeah. Yeah.
So, you know, it's pretty contentious. It really is another hit to property investors in a sort of 24-month period, which has been full of hits. And I think important to mention again that new builds have been mentioned in the commentary. So at this stage, all investors are affected the same way.
Yeah.
However, they're going into consultation. So this particular piece of legislation won't be enacted until 1 October, but it will be retrospective. So it will apply from the 27th of March.
Oh, right.
And at that stage, by the time we get to October, we'll know whether new builds are in or out. So what that means is that either way, new builds are going to be more attractive.
Yep.
So that really sends a signal to the market. The problem we have is that no developers have any stock, as you know. So it's all well and good to say, let's build more new builds, but if the government doesn't make it easier to build new builds, then we're not really going to have an outcome.
Yeah.
And for those that are property developers, they're not probably, I mean, it's not bad for their business, but it's not great for their business either, because as we know, a lot of them don't have anything to sell.
Yeah.
So even if there's more demand, the supply issue is not fixed.
Yeah.
So those that might have bought an existing home, but due to these changes might go, I'm going to buy a new build. They can't do anything anyway.
So that will probably go some way to match supply and demand a little bit more. And it's a manipulation of the outcome that is required. It's not a proper outcome. A proper outcome is build a lot more houses and let the market correct itself. So the thing that I'm irritated. Yes, I'm irritated. The thing that irritates
You can say
me.
it.
You can
Say
say
it.
it.
Let it out.
You know, we deal with a lot of property investor clients, as you guys know, because you're all involved in it. What irritates me is the very, very short time frame. 27 March. We've got days for some clients to make decisions, for people to manoeuvre through banks and restructures if they're underway. Otherwise, people are midway through a restructure right now. If they don't get that sorted before 27 March, then in some cases their interest deductibility is already lost. Because the other little important part of it is that if you already have a property that you own, and it's an investment property, you will have a 4-year period whilst they phase the interest deductions out. So whilst it's all doom and gloom, important to stay calm. We've still got 4 years of interest deductibility, and a lot can happen in that time. But what it really does, this short notice, is it just flexibility's out the window, planning's out the window.
Yeah, absolutely. And when you combine that with the stress that the financial services industry is under at the moment, whether it's regulatory changes, the sheer volume of things coming through the front door, there's not a lot of time for people to get the house in order in a matter of days. It simply isn't going to happen.
And I know we like to usually leave these episodes to 5 to 10 minutes, but I'm just going to ask a couple of more questions because this is a big topic. What do you think are some consequences? So we've kind of alluded to that properties go through cycles and it might not make house prices drop. What do you think are some of the consequences of these changes which maybe the government didn't intend? Because obviously the they've been trying to even the playing field between first home
Yeah.
buyers and
they're-
property
especially
investors.
with rush legislation, you're always going to get some negative externalities that they perhaps didn't, fully consider or think through. Yeah.
And I think the consultation part on the interest part's quite smart on the government side, because they're probably going to get a lot of people who are going to write submissions,
Yeah.
accounting firms, property associations, things like that. But I think the obvious outcome is increased rents.
Yeah.
I think if you've got a mum and dad investor, and I would say that we have at least 1,000 mum and dad investors on the books, some of them won't be making a lot of cash flow. They won't be negative nowadays with low interest rates, but they certainly won't have $9,000 of extra cash to pull out of their pocket every balance date.
Yeah. Yeah.
That's going to have to be recovered from somewhere if they want to keep the investment.
And if just listening to that, sorry to interject, am I right in assuming that if interest rates then increase, this problem will magnify for these investors?
Yeah, it
Yeah.
will.
Okay.
And that is a concern, but I think the government possibly have done their economics on it and know that interest rates aren't going anywhere for a little while.
Yeah. Yeah.
Obviously crystal ball stuff, but not sure. So I think that's one outcome. The other outcome is that if new builds are exempt from both the bright line and the interest deduction rules, we're going to see a huge shift of investor activity away from in situ houses and into new builds. The government, as part of the consultation process, is going to define what a new build looks like.
Yeah.
At this stage, it looks like a property that has had a co-compliance issued within 12 months.
Yeah.
And what is unclear is, does it remain a new build for the whole time you own it?
Yeah.
Yeah.
Exactly.
Yeah, so there's a bit of water to go under the bridge, and that's why I've had a lot of phone calls today, as you can imagine. Everyone's got to stay calm, including me, and some solutions will come out of it. And there's always a silver lining in this stuff as well.
Yeah. Yeah.
Yeah. Great. Okay. Well, I think we'll wrap it up there. We'll go back to our 5 to 10 minute time next week. But this is such an important topic. Really? If you've got questions off the back of this that you'd like us to talk about in further detail, we can get Matt's handsome face back on the podcast. He's been hassling us 3 episodes in to get him on, so it didn't take very long. But please send through those questions, and we'll talk to you next week.
Thanks.